Welcome back to the exchange. Chinese automakers are surpassing U.S. manufacturers for the first time last year. According to a new report, Chinese brands sold 13.4 million new cars, while American brands sold nearly 12 million globally. And leading the Chinese sales is Buffett favorite BYD. It's outperforming Ford, Stellantis, and Tesla so far this year. Speaking of EVs, the demand slowdown in general has sparked all kinds of incentives, from price cuts to leasing offers. And my next guest says companies could be paying for those leases down the line. Joining us is Dan Levy, senior autos analyst at Barclays. Dan, how significant are these discounts?
Hi, Kelly. Thank you so much for having me. Yes. What we're noticing is that automakers are trying to push discounts because the EV demand is soft. You saw early on a lot of outright price cuts, a lot of this spurred by Tesla. But I think one of the observations has been that the elasticity of demand is probably not what some were hoping for. And so they're resorting to other ways to discount, and leases are a key way. You get the full $7,500 tax credit. In addition to that, there are more subtle ways to embed discounts. So we are seeing some increased discounts, but it's occurring in more what we'll call subtle ways.
So Tesla, for instance, has a $299 a month lease for a refreshed Model 3. What are some of the other competitors offering, the American ones?
Yeah, I think the ones that have stuck out to us, we're seeing, for instance, GM, that, some of the deals we were seeing on, for instance, a Blazer EV, where you could get somewhere in the $200 range, call it, $250 for a Blazer EV. Lyric, I believe, was $400. And you're seeing this with Ford as well. Rivian is pushing this as well, but those are obviously more expensive. Those are going to be something with at least $600 to $700 per month. But the point is that it is a way to push the volume. And again, fully capitalizing on that $7,500 tax credit.
Yeah. So as you write, we're increasingly concerned about the profitability of these aggressive lease offerings and believe they're effectively delaying EV losses with some of the new schemes. What's the implication for stocks like GM or Tesla?
Well, the implication for Tesla is obviously it's a sign of, soft demand, and the fundamentals are a clear challenge for them right now. What you are seeing is that some of these discounts actually are, in a way, protecting the residuals for the time being, although they pay for it later on. For companies like GM or Ford, even if they are increasing discounts on the EVs, the key thing to remember is that they are still at their core ICE vehicle manufacturers. And so that, yes, even if the EV demand is weak, there is a strong ICE profit stream to support the numbers. And so at least there is the offset from that.
And I mean, you're talking about the legacy automakers discounting or offering incentives that amount to over 25% of list price, whereas Tesla, by comparison, is only 3% for most of the models, Model Y maybe 13%. But in other words, it's the legacy players who are having a much harder time moving these vehicles.
Well, I think that's the challenge here, right, is that it does tell you that Tesla is still the dominant player in the U.S. market. They hold roughly 50% of the U.S. EV market share. I think that the legacy players, Ford, GM, others, are catching up, but it is still a gap. And I think that speaks to the discount gap that we're seeing. The other thing I'll just point out is it tells you the challenges on the cost front. Tesla is able to offer these more affordable offerings because they have a superior cost structure on EVs. Because the legacy automakers are more challenged from a cost standpoint, they have to price higher. And so it limits what pricing they can offer. And that's why they're perhaps at somewhat of a competitive disadvantage for the time being.
Great point. And now imagine on top of this, if we had Chinese EVs in this country to worry about, which still seems like it's a ways down the road. Dan, thanks for your time for now. We appreciate it.